Okay, hello everybody. How are you? My name is John O'Donnell. I'm the Chief Knowledge Officer of Online Trading Academy, and I'm also the co-host of PowerTradingRadio.com. You might want to write that down. www.powertradingradio.com. There's over 400 hours of content there, and matter of fact, we stream Power Trading Radio off the FX Street website. My email address is john@tradingacademy.com, and at the end of the seminar, you might want to email me today because I have a substantial inventory of webinars I'd be happy to send you free of charge. So let's get started on this. We're going to look at the inflation-deflation debate. I call this the Globalization 3.0 New Normal Economies, and how the world seems to be going through a deleveraged purge era. That being said, currencies are very important because they become the denominator at which we express the value of goods and services. This is the last 100 years of the pricing in nominal terms of the U.S. stock market as denominated in dollars. But if we were to denominate that in another foreign currency, like the Israeli currency or the Argentina currency or the UK currency, it has a totally different pattern of expression. I happen to believe the world is experiencing what PIMCO calls a transition to the new normal, being led by a global credit purge. And you're going to see in a moment how the global credit purge in both the public and private sector is impacting the value or relative purchasing power of various currencies. But what is driving this economic uncertainty that we all face are the three big rocks you see on the screen today. One, the implosion of global trade. Two, the implosion of the household balance sheet in the developed world. And three, banks who have not cleaned up their balance sheet yet and have many non-performing assets that are causing a lot of pain and resistant to recovery. John Mills, a great economist from London in the late 1800s, asked a very important question. He said, "Do panics and crashes destroy capital?" Well, financial panics and crashes, he said, do not destroy capital. Tell that to Lehman Brothers and Bear Stearns. He said they merely reveal the extent to which it has been previously destroyed by its betrayal and hopelessly unproductive works. In other words, the stink or the rot of the flawed economics caused the Greek debt debacle, Lehman Brothers, GM, Chrysler, AIG, Fannie, Freddie, WorldCom, all these other banks and financial crisis that we're experiencing in America to precipitate because of flawed economic assumptions. The financial panic and crash was in essence the symptom of the flawed economic assumptions. In order to look at the value of a currency, we have to take a short look at the inflation-deflation debate. And we're going to look at the inflation-deflation debate today from the Austrian School of Economics perspective and compare it to the view of the Keynesian School of Economics. Now, first of all, if we're going to trade currencies, we have to fundamentally ask ourselves a very important question. What is money? I mean, let's take a look at this picture on the screen here. This is your banker sitting on top of your money at your bank. How many of you believe that's an accurate picture? How many believe that your banker, when you put money into your bank, regardless of the currency or the currency you use, how many of you believe that this is an accurate picture of your banker, bank manager, protecting your money stored in the back of your bank? Type into chat if you believe that's an accurate picture. No, not at all. Where is that money? Well, in fact, there is no money in your bank. Fractional reserve banking across the world does not just stack your money up in the back of the room and let it collect dust. Money has, in fact, been lent out. It's been lent out to either to a government entity that may or may not be attached to a printing press, or it's been lent out into the private sector, into what we call the global bond market. So money supply as defined by the Austrian School of Economics, which, by the way, you can find out information on at www.vcs.org, is in fact defined as cash. In the United States, it's cash plus credit. So if there's $2 trillion of cash outstanding and there's over $50 trillion of credit instruments outstanding in America, what is the most important component of the money supply? Cash or credit? Type into chat your answer. Cash or credit? Well, the short answer to that, you're right, is credit. And the reason it's the most important component of the money supply that we need to keep our finger on the pulse of is that a credit instrument is a unique financial instrument. On somebody's balance sheet, it is an asset, and on somebody else's that same balance sheet, it is a liability. Now think about this for a moment. When somebody doesn't pay their credit instruments off, whoever is carrying that credit instrument on their balance sheet as an asset has to write it off. And that is destruction of capital. The destruction of capital is the definition under Austrian business theory of deflation, not inflation. So let's take a look at this. First of all, let's define our terms today, and then we're going to look at some history of some hyperinflation eras and countries and currencies. According to Webster's dictionary, inflation, in fact, is not an event of a higher price. In fact, it is a process. Inflation, then, is an increase in the volume of money and credit relative to available goods. And to understand this inflation-deflation debate clearly, we must understand that money and credit has both a supply and a demand equation attached to it. Now, this is what the credit purge looks like in the United States. This is the amount of total debt. This is both in the public and private sector from 1870 through 2011. And it shows you that the credit has been growing at a much faster rate than GDP. Now, that's very inflationary, and that is reflected into the price of nominal price goods. But this was the credit. What is the origin of all this inflation? Well, the availability of cheap liberal credit by lending sources and the availability of borrowers to borrow the money and put it to work to buy goods and services. This is the credit binge of the 1920s that under Austrian business theory led the credit purge cycle of the 1930s. Now, notice after World War II that debt as a percent of GDP in America went back to where it was in the 1800s and 1900s, about 150, 160% of GDP for 3 decades. Reagan's elected here. And what did Reagan bring to the party to create all this debt as a percent of GDP escalation, doubling in essence? Well, he brought a lot of confidence. Confidence for what to happen? Confidence for borrowers to borrow, confidence for lenders to lend. And ladies and gentlemen, that's what drove the growth of the American and global economy. Why do I say global economy? Because America is 300 million people strong, but we consume about 22% of what the world produces. And this total mountain of debt, we're starting to see since '07 on the consumer side of the equation, not the government side of the equation. We'll look at it in a moment. But we've seen that consumer debt has peaked here in 2007 at over $12 trillion, and in fact has started to delever. And when we talk about the deleveraging credit purge era, we're not talking about government debt. We're talking about consumer debt. We're talking about that component of debt that's not attached to a printing press as well. So, I'm not going to take the time to read all the government deficit spending programs that we have put in place in America. You can go back and look at the recording of this webinar and stop it at this point and read all the various trillion-dollar programs that we have put forward. And most people believe that we are in a state of hyperinflation, that with all the trillion-dollar deficits that we want to run and the rest of the developed world seems to want to run from Greece and Italy and Ireland and Portugal and Spain, is that we are entering an era of runaway inflation by too much debt or cheap liberal credit chasing a relatively fixed amount of goods and services. But ladies and gentlemen, John Maynard Keynes, the founder of the Keynesian School of Economics, had a lot to say about the moral hazards of inflation. He said by a continuing process of inflation, and he was right, it is a process, not an event of a higher price, of basically too much cheap liberal credit chasing a relatively fixed amount of goods and services. He says that government can confiscate secretly and unobserved an important part of the wealth of their citizens. And that's exactly right. If you want more details on this, Keynes wrote about it in his famous book, The Economic Consequences of Peace, in 1919. There is, and we've seen the impact of inflation on probably most easily observed across the developed world anyway, it's on the price of housing. This is the history of home prices as developed from 1890 through 2010. And this was prepared on constant dollars, that is a dollar of purchasing power adjusted for inflation, by Professor Robert Shiller at Yale University. And today in America, we're back to about this 130 mark. So we've dropped from over 200 all the way back to 130 on average across the real estate sectors across America. But you can see there have been many periods of time where the purchasing power of the currency relative to housing, in fact, the purchasing power has increased in purchasing power relative to a single-family home. And ladies and gentlemen, that is a condition we call deflation. And let me ask you a question today, especially if you live in America. Does it take less dollars today to buy a home in your neighborhood than it did, say, in, 3 or 4 years ago? Well, probably most of you will answer yes. And the reason for that is because the dollar is actually growing in buying power relative to this asset class, as evidenced by the precipitous drop of single-family homes in real terms. So dollars, which, by the way, currencies are an asset class, many of you believe that currencies only become worthless with inflation. Well, that's not accurate. Now, we've had some horrendous periods of hyperinflation, and we've had some devastating periods of deflation. And ironically, most people are more fearful, especially politicians, of deflation than they are inflation. And I'm going to show you in a moment some cultures and periods of time where we've had massive amounts of inflation, which have literally destroyed culture in that particular country. This is my favorite definition of inflation, by the way. Inflation is when you pay $15 for the $10 haircut you used to get for $5 when you had hair. And I'm sure there's a few of you on this webinar today that can relate to that definition. But then, on the other side of this coin, what is deflation? And is it all bad to have lower prices for goods and services? Well, deflation also is a process. As a matter of fact, it is the obverse of inflation. According to Webster's Dictionary, which we'll use today to define our terms, deflation is a contraction in the volume of money and credit relative to available goods. That's pretty easy to understand. You've got less money, less credit available to purchase goods and services. Now, the consequence of this is a falling price. The root cause then of deflation is debt destruction, bankruptcy, banking manifestations, and other manifestations of deleveraging and net change in social mood or appetite for risk. What generally happens when the public senses that prices of goods and services are going to fall in price is they hold back and retard their purchases. And we've seen this in the stock market, haven't we? This is the Japanese deflation and its impact in red on the Japanese Nikkei index. And we've also seen the impact of deflation on the U.S. S&P index in blue. Now look how highly correlated these two situations are. And relative to 1989, the yen, in fact, during this whole period of time, although the Japanese index of the Nikkei has lost over 80% of its purchasing power, and single-family homes in Japan have declined, measured in yen, about 65% peak to trough. In fact, the yen has doubled in buying power relative to the U.S. dollar. Now, Keynesian economists have a difficult time explaining this phenomenon. Well, the Austrian School of Economics does not have a problem explaining this phenomenon. And by the way, that's what we use at Online Trading Academy as our favored economic system, the Austrian School of Economics. Now, I'm laying two charts here for you that many people have not seen. Not only is there a high correlation of incidence between the stock market in Japan and the U.S., but there's a big correlation of price compared to homes in Osaka, U.S. City 10 Composite Index in black, the Tokyo area condo price in purple, I guess that is. And you can see a very high correlation in price change by both these hyper-deflationary economies. Now, how do I come to that conclusion? I come to that conclusion because we just see the symptoms of a declining price as evidence of the deflation process. So in any given sector, at any given period of time, we might have periods of inflation and we might have periods of deflation. Now, if credit is so important to this process, what is the Online Trading Academy forecast for the availability of bank credit as a percent of GDP going forward? And I want to show you this. From 1950 through 2011, bank credit as a percent of GDP has grown from roughly 36% of GDP to over 66% of GDP. We have now turned the corner, and bank credit as a percent of GDP in this deleveraging process is in fact coming down. It is our forecast is coming back to the red line between now and 2015. And that red line, by the way, represents the mean, or the average, of about 44%. And isn't that what markets do over long periods of time? What can we? They are mean reversion animals. That's how markets behave. So let's get into the look of currency. Another important variable on the inflation-deflation debate is the velocity of money. Now, the velocity of money, to simplify it, is simply how fast does a unit of currency circulate through an economy? Is it being hoarded? Is it being saved? Is it being invested? Is it turning over quickly? Because hopefully on every turn of the currency to purchase a good or a service, there is profit being generated in a perfect world. Well, you can see from 1900, the velocity of money in the United States has been about 1.67. This is the black line right through here. In fact, what we find at the end of debt supercycles, where deleveraging is the day of the order, is that we will see falling velocity of money. This is further evidence, and we have seen this for a whole decade now, since 1997, and we are now below the average of 1.67. And I don't believe we're going back to the era of the credit purge deleveraging cycle of the 1930s, where it got down to 1.17, but I do see it coming down into this vicinity right about here on the hard right edge, which would be below 1.50. So we think between now and 2015, we are going to continue to see this deleveraging phenomenon play out. Now, when something like this happens, it really impacts the faith in the fiat money system. And confidence in currencies and the fiat currency system are under a lot of pressure today. As many of you have heard, then we'll talk about this at the end of my webinar today, there is a growing trend across the world and debate to return to the gold standard of some kind, to be defined. So we'll look at that in just a moment. But what I want to look at, and we promoted earlier when we sent you an invite to this webinar, is what is the history of hyperinflation? Is hyperinflation rare? Is it common? What has been its impact in society over the decades? And first of all, let's define our terms, because most people have never experienced a hyperinflation environment. According to the International Accounting Standards Boards, the definition of hyperinflation is a cumulative inflation rate over 3 years approaching 100%. So if a society is deemed to be in a hyperinflation state, which is a state where the currency is rapidly losing its purchasing power parity relative to a constant basket of goods and services, that would be for 3 consecutive years at a 26% per annum compounding for 3 years in a row. Does that make sense? There was another definition by Kagan in 1956, and he defined hyperinflation state as an inflation state exceeding 50% a month. As a rule of thumb, normal monthly and annual low inflation and deflation are reported per month, while under hyperinflation, the general price levels could rise by 5 to 10% every single day. So this is a vicious cycle that is created by government and central bank fiat currency systems in which more and more inflation is created with each iteration of an ever-increasing money printing cycle. And remember, it isn't just the physical money printing we're talking about. We're talking about the impact of credit for people to borrow this hyperinflating currency unit, go out and purchase goods and services before it is extinguished in its purchasing power component. So I'm going to take you now on what the hyperinflation looks like in various countries. Now, I don't have time to read all the text. I have provided text here. You can go back and look at the recording of this webinar at FX Street after my talk, and you can read the text, which gives you some. So I'm going to kind of hit on the highlights of various countries that have gone into hyperinflation states. Argentina had their hyperinflation from 1975 through 1991. In 1975, the highest denomination peso issued was the 1,000 peso. And by the time the inflation was done, in 1981, the highest denomination was 1,000,000 pesos. You can imagine what happened to the purchasing power of that currency. Then let's take a look at the hyperinflation happening in Angola from 1991 through 1995. We saw a massive hyperinflation where the currency unit goes from 1,000 to over 5 million. Massive loss of purchasing power in that era. There was a hyperinflation in Austria in 1922, and then from 1914 through 1922, the consumer price index in Austria was up over 11,836%. In Belarus, there was a hyperinflation from 1994 through 2002. In Bosnia and Herzegovina, they had their worst inflation in 1993, where a dinara goes from 1,000 units to over 100 million units, and then eventually in 1993 to 50 billion dinara notes that were printed. Massive loss of purchasing power. In Bolivia, we had a hyperinflation from 1984 through 1986. Can you imagine being a currency trader in these countries during this period of time? There was a 1,000,000-to-1 replacement of the fiat currency by the Central Bank of Bolivia. A lot of people remember the Brazilian hyperinflation from 1986 through 1984, where the Cruzeiro virtually became worthless, worth about 1 trillionth of a U.S. cent, and adjusted for inflation and multiple devaluations, inflation reached 2,075%, and a new currency was actually adopted, replaced the Cruzeiro with the real. And 1 real is the equivalent of, my goodness, 2.75. You read the number of zeros that are behind this. It's absolutely staggering. All of this is created by government, by the way, or the central bank of the country. that's attached to the government. Bulgaria, free city of Dazang in 1923, where the 1,000 mark was ultimately replaced by the 10 billion mark. Georgia had a recession in 1994. So you can see many of these recessions and runaway inflations, and you can imagine how devastating it was on the culture. We can look at this in a moment because the people were not prepared. They did not understand how to protect themselves in an environment like this. Let's take a look at the Greek. We've heard a lot about Greece's problems, but their worst inflation, hyperinflation, was in 1944, I'm sorry. In 1942, the highest denomination was 50,000 drachma. One drachma was eventually exchanged for 50 billion drachma. Can you imagine that? You imagine how the credit, the bonds issued by government and or corporations in these countries that were denominated in these countries. This is one that's very near and dear to Online Trading Academy, and I didn't know about this until I started doing research for this webinar. But Israel, the founder of Online Trading Academy is from Israel. His name is A.L. Shahar, and he founded the company in 1997. I joined him in 1998. But one of the reasons Online Trading Academy was formed in 1997 was because of the inflation that Israel had in the 1970s. Their inflation went from 13% up to 111% by 1979, up to 133% by 1980, and then up to 445% in 1984. And the Israeli shekel was literally wiped out in purchasing power. And that had a big impact on the founder of Online Trading Academy because he was devastated. The Israeli economy collapsed, stock market collapsed, his wealth disappeared, and he decided to open up Online Trading Academy to give people financial education so they would never experience this kind of cultural hardship. That's a true story. Serbia had a hyperinflation in 1993. Mexico had a hyperinflation in the 1970s. North Korea had their hyperinflation, been going on from 1947, never really stopped. It's still been going on through 2009. What about Nicaragua? Nicaragua went through their worst inflation rate from 1987 through 1990, and where one Cordoba was reissued with a 50 billion Cordoba. Think about this. Philippines had a hyperinflation after World War II. Poland, from 1921 through 1924, had a terrible hyperinflation. They also had another one. They didn't learn anything from the first bout of it. And they had another hyperinflation from 1989 through 1991. And then let's not forget Peru. Peru experienced their worst inflation between 1988 and 1990. I mean, the question I would have, that was basically an inflation of 1 to a million. Can our government officials learn nothing from history? You know, some wise man said, those of us that can't learn from history are doomed to repeat it. As a matter of fact, I think that was Mark Twain who had that to say. What happened to good old-fashioned statesmanship and conservative politics? Can we learn nothing, but you cannot print your way to wealth? Deficit spending and massive printing is not a solution to good old-fashioned productivity. Romania experienced hyperinflation in the 1990s. That means 500 lei became 5 million old leis. Can you imagine what happened to the value of all the bank accounts and the bonds issued by both government at state, federal, and local level and by corporations? Savers were absolutely wiped out. Soviet Union had a major in hyperinflation between 1921 and 1922. Taiwan had a major inflation in the 1940s, basically a 1 for 1 million conversion. And what about the Ukraine? They had their worst inflation between 1993 and 1995. Again, you can go back to the recording and read stop the recording and read all the text. But in the Ukraine, inflation got to a point of 1,400% per month. And then by 1993, inflation was running at 10,000%. I assume that's on an annualized basis. You can imagine what happened to the currency unit. Yugoslavia had a terrible hyperinflation in 1993. Zaire, of course, had a major inflation. One currency unit was ultimately exchanged for 3 million currency units, which China has experienced several hyperinflations. I find that socialistic and communistic totalitarian regimes are famous for these hyperinflations, if you've seen from the previous examples. But their worst inflation was between 1948 and 1949. That's about the time that Mao took over. And of course, he immediately had a 1 for 10,000 conversion of the currency. Now, the most famous period we will look at is Germany. Everybody, how many of you have heard of the Weimar Republic? The hyperinflation had happened in Germany around the early 1920s. Matter of fact, I believe it was between of course, we've all heard of Zimbabwe. We'll look at Zimbabwe in a moment. But what do you imagine was the social impact of the famous Weimar Republic in the very early 20s? Because there are besides the speculation and there are major cultural impacts on society when these inflations come about. Yeah, I think you're right. I think the Weimar Republic event helped bring to power a guy called Hitler. And what was the impact of that culturally? Well, 40 million people were extinguished in Europe I tie the social phenomenon to the central bank of Germany as much as I do the rise to power of Hitler. Hyperinflation in Germany, we'll take a closer look at here. The biggest note they printed was a 50,000 mark note, but by 1923, this 50,000 mark note was a 100 trillion mark note. Wow. We'll take a look at the exchange rate on the German mark to the U.S. dollar in just a moment. You will be stunned to see how it can happen. Look at this. In 1914, it took 4.2 German marks to buy 1 U.S. dollar. By 1920, in January 1920, it took 64 marks to buy 1 U.S. dollar. By January 1923, it took 17,972 marks to buy 1 U.S. dollar. But folks, take a look at this. By December 1923, the exchange rate was it took 4.2 trillion marks to buy 1 U.S. dollar. So in a relatively short period of time, we go from 4.2 Reichsmarks to 4.2 trillion Reichsmarks to make 1 by 1 U.S. dollar. Folks, that's devastating. Now, there are stories, and I believe they are true stories, where people were literally paid with wheelbarrows full of money. The husband would meet the wife at the gate and be paid twice a day, literally with a wheelbarrow full of money, and that would buy you a loaf of bread in Germany. The currency became so worthless, one of the common uses for the currency was to use it as wallpaper in Germany. And women would actually find the banknotes on the street, and they would cook or burn the banknotes as a cheaper fuel because the price of a cooking fuel had so escalated, it was much easier just to burn the currency to cook a bowl of porridge. Now let's take a look at this chart. This is the purchasing power of 1 Reichsmark and loss of purchasing power. Can you imagine what happened to the price of gold? from roughly 1918 through 1923. In other words, this was the value of a 0.3584 grams of gold converting into Reichsmarks. And it basically goes from 1 to, what is that? $1 trillion or 1 trillion marks to buy a unit of gold. Wow. Amazing. Simply amazing. Here's another major hyperinflation that not many people know much about, and that was in Hungary between 1945 and 1946. A 1,000 note Pingo note, I'll show you in a moment, was ultimately highest denomination became 10 to the 21st power. Look at this. 1,000 Pingo note eventually became a note with 10 to the 21st power. Look at all these zeros behind that in circulation. And this is what that note looked like. This by 1946, it was 4 times 10 to the 29th power for one of these notes in Hungary. The notes again became so worthless that they were literally thrown away. And here's a gentleman sweeping the notes up off the street. Here it was 10 to the 20th power, which is 100 quintillion Hungarian Pingos notes. Okay. All right. Very good. Now let's talk about the king currency, which is Zimbabwe. This is the hyperinflation. The hyperinflation, everybody's heard of the Zimbabwe. Somebody we give a lot of seminars at Online Trading Academy. We have 35 centers across the world, and somebody brought me in a $100 trillion note from the Bank of Zimbabwe. They had just visited Zimbabwe and brought this home. This is really the king of hyperinflation. One of the very kings of recent time. This is that a 100 trillion Zimbabwe banknote. Wow. Had gone to 10 to the 27th power. I mean, you do the math, folks. You can go back and read the text here. It's absolutely stunning. In July, inflation in July of that year had surged to 2.2 million%. Unbelievable. At 2008, the Zimbabwe dollar, $1 would buy you 688 billion Zimbabwean dollars. Stunning. Now, this is what $1 trillion looks like, stacked up in the bank of your bank. And, of course, all of these currencies, as you know, are convertible into gold. You see, ladies and gentlemen, gold is a currency. Gold is not a commodity. Now, the role of money is to be a medium of exchange and a store of value. As you can see from the hyperinflation currencies we've looked at, all hyperinflation currencies can be a medium of exchange of varying credibility, but none of them became a good store of value relative to purchasing power versus gold. And you can imagine in those countries of those years that many units of currency were converted into precious metals, specifically gold and silver, to be a good store of value. This is what's happened to the purchasing power of the U.S. dollar, by the way, since 1914. It's basically lost about 96% of its purchasing power. Not as bad as some of these other hyperinflations, but not too good, to say the least. This is what's happened to the purchasing power of the U.S. dollar in grams of gold. It's virtually been destroyed. And this is what's happened to the purchasing power of the U.S. dollar relative to gold for the last 13 years. So, and this, of course, is what's happened to the Nikkei index. priced in grams of gold as well. So and this is what's happened to the S&P, priced in grams of gold. So I'm going to stop right there. We got a few minutes left. Are there any questions that you might have for me? As you can see, we've had lots of issues with currencies. That does not mean, by the way, and one of the things I like to do is I like to use gold as my denominator. How is your currency of the country you live in? How is it performing relative to gold? You know what I'm saying? Well, I don't believe that gold is in a bubble. I don't believe gold is in a bubble at all. As a matter of fact, if you take a look at this, we've seen the case where gold relative to the S&P, gold is in a bubble relative to what? Relative to the stock market, the real estate market? Relative to what? I don't think gold is in a bubble. I think what you need to do is study the price history of gold relative to other assets. Take a look here. From 1932 through March of 1933, gold was trading at 4.5 times the price of the S&P. Okay? Well, the S&P today is trading at 1,300 times 4.5. You do the math. In 1980, gold was priced at 6 times the price of the S&P. So if you take 1,300 times 6, that's where gold would be priced today. Now, the average gold price to the S&P is about 1.4 times the price of the S&P. So if I were to take 1,300 and multiply it by 1.4, that should be about the average price of gold. And that's about where it's priced today. So I do not believe gold is in a bubble at all. You have to compare it to something else. Relative to what is gold in a bubble? I don't think it's in a bubble relative to the dollar. Not at all. So, ladies and gentlemen, I've enjoyed being with you today. My name is John O'Donnell. I want to go back up here. Here's my email address. I have a whole bunch of, 308, I believe it is. Here's my email address, john@tradingacademy.com. I'm also the co-host of Power Trading Radio and one of the principals in Online Trading Academy. Visit our website, lots of free stuff. I've got a lot of other webinars to send you. Just email me, john@tradingacademy.com, and I'll be happy to send them to you free of charge. I've enjoyed being with you today. God bless you all. Good luck.